Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and let's dive right into it. Last week, the S&P 500 dropped a small amount. I think it was 0.19%, and our portfolio remained flat because we were in a trade, and that trade was made prior to last week and it expired on Friday. We'll go through that trade. I'll show you that in great detail as we go through the presentation. Currently, for the year, the buy and hold investor for the S&P 500 is up 6.49%, and our portfolio is up 1.6%. Our goal here at Spy Trader Now is to beat the returns of the buy and hold investor for the S&P 500. We do a 3-position portfolio where we either have shares of the S&P 500 and we purchase the electronically traded fund symbol SPY, or we buy options and we do both calls and puts, or we are in cash. Currently, we are 100% in cash. Our portfolio has a value of $101,595. We start the year off January 1 each year with $100,000 as our starting capital, and we go from there trying to beat the S&P 500. So this is where we stand year to date, up 1.6, S&P 500 up 6.49. Here at Spy Trader Now, we are not buy and hold investors. We buy, sell, and trade the S&P 500. We try to put more of this green in your wallet. Now, here is a one-year chart for the S&P 500, but we're going to go through the charts in much greater detail later on in this presentation. Here in this chart, you can see where we had a trade, and that trade, which was a covered call, expired where this red line is, which was on Friday's action, which is yesterday, and it had a strike price of 400. So we sold an in-the-money covered call. See here, we placed the trade on 2/2/23, $400 strike with an expiration of 2/17. Today is 2/18/23, and that expired in the money, so the shares got taken away and we made our money on that trade, because when I placed that trade, I did have an expectation the market was going to soften, but not below $400 per share for the fund. Here are some past results for Spy Trader Now. You can see we had these were all great returns across all of the past 3 trading years. Last year, 2022, we returned 21% when the market returned negative 19%. That's a 40% differential. And then we had 78% in 21 and 100% in 2022. So we did very well in these years. So follow along. If you want to see how I do this, go ahead and hit that subscribe button, ring that bell to be notified when I post a new video, and go ahead and do me a solid and click on that like symbol to help me promote this video. Thank you. So last week, the S&P 500 dropped 0.19%, very, very small. You can see here the trading action, and you can see in the thumbnail, it's just kind of drifting slightly down and to the right. Here's that trade that I told you about. We made on February 2nd. We did 200 shares, and SPY at that time was trading at 415.63. And this was the exact trade. We put that into our calculator here. This is the covered call calculator. You can get this calculator for free. Just go ahead and head over to Spy Trader Now and check out documents, and you can download it for free. But here's the returns of that trade, and our annualized return on that trade was a 14% annualized. Of course, we didn't get 14% because we were only in the trade for 15 days. And here is how we monitor our trades. So here in 2023, these are the trades that we've made so far this year, and here is our portfolio value. You can also, if you want to see my full trade list going back for the last 3 years, you can head over to spytradernow.com. There'll be a link down below, and you can see my full trade list, and you can sign up for my real-time trade alerts. This is the equity curve of our portfolio for Spy Trader Now for 2023. So you can see how we're just basically slowly crawling along. This is the equity curve for the SPY buy and hold investor. They had a really strong few weeks in the beginning of the year, and in the last 2 weeks they've tapered down and to the right slightly. Still holding strong though. Here is a comparison of the two strategies combined. So the SPY buy and hold investor here in pink and the SPY trader now portfolio here in blue. Our goal is for this blue portfolio to surpass this pink portfolio. Obviously, we haven't done that yet. We have more work to do ahead of us, but that is our goal. Okay, so here is the Fed chair. His name is Jerome Powell. This is the man that makes the top decisions about where interest rates are headed here in the United States for the Federal Open Market Committee. Now, the last rate hike was done on February 1st, 2023, 25 basis points, and that brought the federal funds discount rate to 4.5 to 4.75. Forbes has it pegged for the terminal rate for 2023 to go to 5 to 5.5. So we have more interest rate hikes ahead of us. You can get that information here at this link, and I'll leave a link down below if you want to jump to it yourself. The next FOMC meeting is on March 21st and 22nd. The announcement will be made on March 22nd. There was an expectation for this rate hike on March 22nd to be a 25 basis point rate hike, but the inflationary data that came out during the past week was extremely bullish. I shouldn't say bullish. It gave an indication that there is now a greater possibility that on March 22nd, Jerome Powell is going to raise interest rates not by 25 basis points, but by 50 basis points. So if the economic data continues to come out strong, that's not his goal right now. Right now, Jerome Powell wants to get inflation lower. So he wants the economic data of the United States to be dropping down, showing that these rate hikes that he's made here in the past are actually taking hold and they're slowing down the economy. He wants to do that because inflation is getting out of control. It's above his target rate of 2%. Now, if that data continues to show strong between now and March 22nd, that will increase the likelihood of the 50 basis point rate hike. So that's where this stands right now. We have to monitor this closely because the market and how much the market goes up will be dependent upon what this man does on this rate hike and the words that he uses during the announcement. If he's extremely hawkish, then the market doesn't like that. They like a dovish Fed where they're easing towards the market. Right now, he's actually done a pretty good job in producing a soft landing for the economy here in the United States because right now jobs are plentiful, everything is still strong, nobody is in real dire straits as a whole, as a country. So he's actually doing a pretty good job as a Fed chair right now, but we just want to monitor this and we need to watch it because it's really depends on how things are going to go and how the market reacts to what he says and what he actually does. What we really need to watch very closely. And that's why we monitor this. Now, this is from a bond market outlook. We currently have an inverted yield curve. And what that means is that the longer term 10-year Treasury notes are at a lower interest rate than the shorter term 3-month and 2-year yields, which have a higher interest rate. This is backwards. This is the 10-year, the longer term, is supposed to have a higher interest rate than the shorter term. But the bond market the yield curve for the bond market is inverted. And that is a very big red flag. So it's a very bearish stance to have an inverted yield curve for equities. And by the way, every time you have an inverted yield curve, there is a recession economically for the United States. 2 downward quarters with lower GDP. So that is what the expectation is for calendar year 2023. Until things change, that's the expectation. Another thing that is not good for equities is that we have a rising interest rate market. 1 year ago, the 10-year was at 2.05. Currently, it is 3.77. Obviously, this number is higher than that number, meaning we have a rising interest rates. That from a bond market outlook, it's not good for stocks. So this is one of the reasons why, until things change, at least until that inverted yield curve changes, I'm going to remain very dovish on my trades. I don't want to take on a lot of risk because there's a lot of risk in the market with this stance. Now we're looking at it from a seasonality standpoint. We take the last 20 years for the S&P 500 and we see how we did each month of the year on a seasonality basis. In February, our current month, 65% of the time, it closed higher than when it opened for the last 20 years. So that's pretty good. So where do we stand currently for the month of February? For the month of February, the market is currently up 0.19%. Ironically, that's the exact amount that the market dropped last week, which is funny. That's just a coincidence. But anyways, what does that tell you? Well, it tells you from a seasonality standpoint that we're going to move sideways to slightly up because there's a 65% chance that we're going to close higher than when we open the month at. So there's pretty good odds to put some money on the table right now. So from a seasonality standpoint, it's a bullish stance. Now here's a long-term outlook. This chart here is going back 20 years for the S&P 500, and this is a monthly chart. So what's happening here is we were in this downward trading range. We just broke above this resistance line, which now acts as a support line. As long as we stay above this line, it is going to be bullish for the market. If we drop below this line, it's going to be bearish. The more we drop below it, the more bearish the market is. Right now on the MACD set at default settings, we've kind of bottomed out. The histogram is showing promising signs of going up, but the actual MACD line is actually kind of going flat. So I'm thinking that this is going to kind of move sideways to slightly down over the next 2 weeks. That's my expectation. We'll get into that. This is a weekly chart for the S&P 500. And so each one of these candlesticks, and you can see here in the thumbnail a little bit better than the actual body of the chart, each one of these candlesticks represents 1 week's worth of action. So we're just drifting sideways to down is what's been happening. And we are currently below the 410 resistance line. This is the old highs right here, the 410. We're just trading just below the 410. If we want to say that this is a trading range, 390 to 410, we're at the upper end of that trading range. This is that downward sloping pattern I told you about. I would not be surprised to see this market come down and tag this now support line and also the 390 line over the next 2 weeks. That is what I would not be surprised to see. That's completely within the cards, still maintaining a bull market and allowing the market time and some pullback to digest this move that it had recently. Here's the market on a daily time frame. So this is a short-term outlook. You can see we've moved sideways. This was that trade I told you about earlier in the presentation. And we closed within the money, and that is why our shares got taken away, because I placed an in the money covered call. So right now we're in a cash position and we need to determine what we want to do with our cash. The market here in the MACD, you can see that the MACD is below its signal line on the daily chart, and the slow stochastics is also below its signal line and traveling down, giving me further evidence that we're going to come down and potentially tag this 390 level. Now I've added a chart to today's presentation. That's this chart right here. In this chart, it's going back 6 months. So it's a daily time frame, S&P 500 But instead of doing 1 year's worth of data, it's only 6 months worth of data. So it's a little bit closer zoom in lens look of what the market is doing. You can see we were in this trading pattern. We have come out of that trading pattern, and now we're in this new trading pattern. We've developed this new trading pattern is what the market has developed. We are smack dab in the middle of that trading pattern. We can easily come down here. So it's possible that we may not even come down to the 390 level, but it looks like we're going to come down. We could potentially come up, tag the 410, and then come down. So until we come out of this range, we are in this trading range between the 410 and the 390. And 390 might be a little ultra conservative, but it is definitely conservative. And considering where the bond market stands, it doesn't hurt us to take conservative trades right now until things change economically. This is a chart of the VIX, which is the volatility index, or known as the fear index in the market. When the market is trading and moving sideways below 20, that's bullish for equities. But when you start spiking up like this here, that is when you lose money. This works inversely to the stock market. So when the VIX goes up, the stock market is actually going down. That's why I put this arrow in red. You make good money when the VIX is at a high level and traveling down. That is when the S&P 500 makes money, and that's why I put this arrow in green. I also put in notes here. This is when you want to buy the SPY long and you want to sell the S&P 500. These are the same thing. The SPY and the S&P are the same. And you want to sell the S&P 500 when you're at this lower level, but not when it's moving sideways. You want to sell it when it's moving up like that. So you want to monitor to see what it's doing. We were in this downward wedge pattern, which I knew we were going to break out of, and we've since been moving sideways. That's okay unless we start breaking above this 22 level, holding it and continuing to go higher. Then you definitely do not want to be long equities. This is a chart for my broker, which is TD Ameritrade. This is a chart, 1 year chart, S&P 500. And on this chart, you're looking at standard deviation lines in gold, which are the -2 and the +2, and in pink, the -1 and the +1. 95% of all trading takes place between the +2 and -2 standard deviation lines. You can see we are at the upper end of the standard deviation here on the chart. When you come down and you're in this lower range, then it's better to take on more risk because you have more probability of going up. Here, when you're up high on the chart, you have limited upside potential with more downside potential. So that is another reason to stay conservative on our trades until this pattern changes and this comes down to the lower -2 standard deviation, or at least below the -1 standard deviation, before we take on more risk. This is the same chart, but instead of going back 1 year, it's only going back 3 months of data. This middle green dotted line is the halfway point between all your standard deviations. So from this standpoint, we're smack dab in the middle, just moving sideways. So the market can go 50% that way and 50% that way. And that is where it lies. But considering that your MACD and your slow stochastics are both pointing down, I think that we're going to come down and potentially tag this green line. The solid green line is the 50-day moving average. This black line is the 200-day moving average. I think we're going to come down and potentially tag the 50. I highly doubt we're going to go past the 200-day. All of these numbers are above the 390 level. You can see that the 200-day here is just about 392, 393-ish. This is the holiday schedule for the New York Stock Exchange, which is the stock exchange that we trade. So the NYSE in 2023 has a holiday on Monday, February 20th to observe Washington's birthday, or President's Day. So our next trading day that we can possibly place a trade is on Tuesday, February 21st. This is my market summation as of February 18th, 2023, according to SPY Trader Now. The market is expected to move sideways to slightly down over the next 2 weeks. In order to participate in market action and have some downside protection, we will sell a cash secured put. And we'll do this on Tuesday when the market opens, with February 24th, 2023 as the expiration date, 390 is the strike. And I have a calculator, my cash secured put calculator. I put all the numbers in. That's going to give us an annualized return of 7.18%. We're not getting that because we're only in the trade for 3 days. The actual return is just going to be a very small 0.006% return. That just bumps our portfolio slightly. It gives us 4.29% of downside protection. The market would have to move that much for us to not be profitable in this trade. We have a break-even price of $389.77. We're good until the market drops below $389.77, which I doubt it's going to do in the next 3 trading days. So this gives us some skin in the game. We make a very small return on investment, and we will let the market, we'll see what the market does over those next 3 trading days of next week. This is the actual trade, how you put it into my broker for TD Ameritrade. And if you want this calculator, you can get this calculator for free and just go over to spytradernow.com, go to the document section, and you can download it. And that is also going to conclude this video. If you have not done so already, please click that subscribe button, ring that bell to be notified. Do me a solid, click that like button to help me promote this video. And I wish you good trading.